Hi, good afternoon to everyone. Today, markets have corrected. It's a very volatile and uncertain market. And I hope and pray that this presentation gives you some data and some thoughts to anchor or navigate this volatile market. Next slide, please. If you look at global economy, COVID-19 to anchor economy, COVID-19 and thereafter runaway inflation, both has impacted growth outlook. Globally, economies will start slowing down thanks to the COVID-19 and runaway inflation. This is also reflected into growth optimism. It's now at a decade low level. If we look at equity and debt, normally they don't go hand in hand, but this time not only equity have fallen, but also the bond market. If we look at equities, it's fallen across developed market like US, Europe, UK, Japan, but also equity across emerging markets right from India and China to Taiwan and Brazil. US has made one of the worst beginning for S&P 500 in this calendar year. It is down in the most possible dip since 1974. Not only S&P 500, but also Nasdaq has corrected heavily. Number of stocks which are down 50% is more than 45% of the total stocks in Nasdaq. 22% stocks are down more than 75%, and about 5% of the stocks are down 90%. The revenue growth of FANG companies wise Facebook, Amazon, Google, Apple, and Netflix has fallen to decadal low. Commodity prices have risen to all-time high level thanks to disruptions caused by COVID and fiscal stimuluses and monetary stimuluses given during the pandemic. This has created a unique scenario where technology-led companies like Facebook, Amazon, Apple, Netflix, Google, and commodity producing companies like Freeport, Alcoa, Newmont, Nucor, and Steel Dynamics, now they have delivered similar return over last 5 years. The commodities to equity ratio has come down to all-time near low level. It probably indicates that going forward, equity is poised to do better compared to commodities. While in US, valuations are still at the higher level, broad emerging market and broad non-US developed markets have corrected back to the pandemic lows. Obviously, India is an exception, and it is more like US, where correction is not comparable to pandemic level. Inflation across the world is running at a higher level. In some countries, it is at decadal high. In some countries, it is at 50-year and 70-year high. This has pushed global central banks to raise interest rates and take away liquidity. Within that, developed market were little bit behind the curve. Emerging market were little bit in line with the curve. Consequently, emerging market yields have hardened little less compared to the developed market. There was a time when about $17 trillion worth of bonds were carrying negative coupon or negative yield. Now that has come down to below $4 trillion. US economy delivered minus 1.4% GDP growth in the first quarter of this calendar year 22. Put all these things together, it will be fair to say that global economy is at crossroad. On one side, Russia-Ukraine situation will impact sentiments. On other side, inflation will push central banks to raise rates and take away liquidity. That could cause recession or significant drawdowns. As era of ample liquidity and cheap liquidity comes to an end, valuations will get corrected across all asset classes. Within that, Indian economy till now has some brighter spots. Compared to others, our pain is relatively less. Tax revenue went up to all-time high of 27 trillion in FY22. Services exports crossed $250 billion, all-time high number. Goods exports crossed $400 billion in FY22, again a record. Gst collection came for March month at rupees 1.68 trillion, again the highest since the launch of GST. The PMI numbers have started improving in April after a drop in March. FASTag collection has touched 4,000 crore plus in April 22, again much higher than pandemic time. Put all these things together, in Indian economy we have brighter spots despite global challenges. If you look at on a longer term basis, between 2014 and 2021, our economics, our GDP moved from 10th largest economy to 6th largest economy. Our share in global GDP moved from 2.6% to 3.2%. Our share in global trade and services moved from 2% to 2.2%. Foreign direct investment flows, we moved 2.1% to 6.7%. Auto production, 7th largest to 4th largest. Steel production, 4th largest to 2nd largest. Mobile phone, 12th largest to 2nd largest. And consequently, based on that performance, our weight in emerging market moved from 6.6% to 12%. Our weight in BRICS countries moved from 13.5% to 21.5%. So over last 8 odd years, we have achieved reasonable amount of growth. Our challenge will be that in this global uncertainties, can we continue to maintain the momentum? The activity levels are firmly above pandemic level. All the high frequency indicators from e-way bill to GST collections to power consumptions to exports to railway freight are showing remarkable improvement and firmly above pandemic level. Credit growth after years of slowdown have now started recovering and touched double-digit number after a long gap. This is also happening in a period where corporates have deleveraged their balance sheet and overall corporate debt to GDP ratio has fallen from about 55, 57% to just around 50%. This is also reflected in banks' credit quality. The credit ratio is seeing remarkable turnaround. Gst collection, as I mentioned earlier, for the month of March has come at all-time high level of 1,67,000 crore. The expectation is that there will be normal monsoon this year, average monsoon this year. That's also positive for agriculture and overall rural economy. Compared to other emerging markets, we are in a far better situation from a capital outflow point of view or from a food grains point of view or in terms of exposure to Russia by way of our trade and exports. Our vulnerability continues to remain on the energy import side. We are dependent upon rest of the world for giving us crude oil and other energy related stuff. As I have mentioned repeatedly, in India's Kundli, Rahu and Ketu both are linked to higher oil prices. If oil goes higher, our economy suffers. If oil comes down, our economy does well. A 10% rise in crude means about 20 basis point impact on GDP growth, 40 basis point impact on CPI, and 30 basis point on current account deficit. In that scenario, equity markets have done reasonably well. The small and mid cap continues to outperform large cap over last 1 year. Over 1, 3, 5, 10 year, large, mid and small all have delivered double-digit return. This year's rally is driven by energy, metal and private sector banks, whereas technology and real estate and pharma have underperformed the market. FPI selling has been relentless. They have now sold more equities between October 21 to April 22 compared to what they had sold during 2008 global financial crisis. While FPIs have been on the selling spree, domestic investors have continued to buy, led by mutual funds and retail investors. If we see when domestic investors end up buying, during various periods, the outcomes have changed. For example, between Feb to May 2000, Nifty came down 30%. FPIs were buyers then and mutual funds were sellers. Now, between October 21 to April 22, FPIs have sold 1,65,000 and mutual funds and domestic investors have bought 1,40,000 crore and market is barely down 8-10%. Clearly, domestic investors have now moved in a leadership position of absorbing FPI supply. Consequently, domestic institutional investors' ownership has started moving up. If you look at India's performance vis-a-vis rest of the BRICS countries, we have delivered significantly better return compared to BRICS countries. However, this outperformance over BRICS nation is partly because of our superior earnings growth and also partly because de-rating of those equities. We now trade at a significant premium to other emerging markets based on our historical averages. Valuation wise, we are recommending neutral weight. Momentum, there is a printing error. Momentum right now is negative or volatile rather than positive. The market cap to GDP ratio has come down to 102%. Historical average is about 81%. But global market cap to GDP ratio is 124%. And hence we believe compared to global averages, we are in reasonably good shape. Average P ratio for Nifty has been about 18.4 times. Currently, we are trading roughly at a 19.4 times little premium compared to the historical averages. The result season so far has come out quite nicely. PAT growth of Nifty 50 companies which have declared results till now, about 25% growth is visible. This was against expectation of about 20% growth. And after declaration of this result, 15 companies have seen earnings upgrade and 9 companies have seen earnings downgrade. We believe for FY22, Nifty EPS will be about 735 rupees. And for FY23, we should be nearing earning per share of Nifty at 871 rupees. This makes market trading roughly at about 19.4 times. At this point of time, due to all these uncertainties, our call remains equal weight to equity. Within that, our preference is marginally overweight large cap and marginally underweight small and mid cap. The markets are today swinging between various concerns and hope. The first concern is what happens geopolitically. There are hotspots like Ukraine and Russia, China and Taiwan, India and China, Middle East, which is boiling. We believe how this event shape will determine direction of the market. If Russia uses nuclear bomb or nuclear option in Ukraine, obviously markets will correct. If there is a settlement between Russia and Ukraine, obviously markets can bounce back. The second thing for us to worry about is inflationary pressure. RBI has acted out of turn to raise interest rates by 40 basis points. Hopefully, inflation will get moderated with RBI's action, and that will support the market. But in case inflation continues to remain higher, that will prompt RBI to raise interest rates and cut liquidity, and that will have direct impact on valuation. Hi, can I request other people to mute themselves? If we look at commodity prices, they have moved up significantly in CY22, and that's going to impact some companies' results. We have seen variety of trends in earnings declaration. Commodity companies have made money. This year, Tata Steel's profit is higher than Tata Consultancy Services. On the other hand, commodity users are suffering. In this kind of scenario, we will recommend you to maintain your discipline. Kotak Multi-Cap Fund we had launched last year. My colleague Devinder Singhal manages that. And if you look at performance of Kotak Multi-Cap, it has delivered reasonable performance once its money were fully deployed. Currently, it has about 43% allocation to large cap, 29% to mid cap, and 25% to small cap. This is based on the minimum requirement of keeping 25% each in small, mid, and large. We had also launched Kotak Global Innovation Fund of Fund. Since the launch, fund has remained more or less below issue price. This fund, has been impacted by certain events which we had not predicted at the time of the launch. If you see between 2017 to 2021, the fund continued to do extremely well. Based on that performance and portfolio, we had invested in this fund. But since the launch of the fund, one after another, events have come and hit this fund's performance. The first was China tech sell-off. Overall, Chinese stocks are down more than 70%. This fund had about 10% allocation to China stocks, and it lost significantly over there. Thereafter, Nasdaq correction came. And in Nasdaq, while index hasn't been down much, a lot of stocks have fallen between 50% to 90%. Combination of this resulted into this fund's NAV dropping significantly from the launch price. Today, when we believe it is time to invest in Global Innovation Fund because of the mutual fund or offshore investment limit, we are not able to take any money so that investors can average at today's valuation. So everything that could go wrong in this fund is going wrong. We still remain very hopeful about this fund. It is managed by Wellington Asset Management, one of the largest asset management company in the world. They have restructured their portfolio post-China tech sell-off and post-Nasdaq correction so that when markets recover, this portfolio can participate. This has combination of good innovative companies across US and the rest of the world, across technology and non-technology sectors. And we believe, despite a very disastrous performance from beginning, it has good potential to recover. Our funds continue to generate alpha across most time periods. Even in our hybrid funds, we have continued to generate alpha across most periods. If you look at SIPs, our funds continue to generate alpha, except Kotak Flexi Cap Fund. Even in hybrid funds, alpha generation is truly remarkable. One particular fund I would like to I would like to talk about is Balance Advantage Fund. My colleague Harish Krishnan manages this fund. When index goes up on the higher side, it gives you 56% participation, and when index falls, it gives you 36% participation. The ratio of upside participation to downside participation is roughly about 1.55. So it delivers 55% more participation on upside compared to downside. The current allocation of this fund is about 43% in equity, and rest is in arbitrage positions and other debt instruments. Depending upon investors' profile of being super conservative to super aggressive, across our hybrid equity and other funds, we have recommended what kind of allocation should be done. For example, a super conservative investor should do SIP in Kotak Debt Hybrid Fund, Kotak Equity Savings Fund, Kotak Balance Advantage Fund, or Kotak Equity Hybrid Scheme. Similarly, someone who is super aggressive can come in small cap and mid cap fund like Kotak Small Cap and Kotak Emerging Equity. They can even look at concentrated large cap biased fund like Focused Equity, which my colleague Shivani manages, or they can look at some of the offshore and sectoral funds. I hope this slide gives you some indication about what kind of funds one needs to choose for regular investment, depending upon the risk profile of the customer. As you are aware, we had recommended investment in gold. In 2020, that call delivered good performance. In 2021, that call delivered negative return. But in this year-to-date performance so far is fairly good. We believe this is still a good price to invest in gold, keeping in mind that China might be an aggressive buyer of gold to diversify its FX reserves after seeing what happened with Russia, where more than $400 billion of their reserves have been frozen. Gold to equity ratio in US also looks attractive in favor of gold. So this potential China buying, along with current global uncertainty and looking at the equity market, it gives confidence that gold can be considered for investment over next 3 to 5 year horizon. Gold generally does well in higher uncertainty, and right now world is struggling between COVID and Ukraine. On crypto, we got some good insights from Berkshire Hathaway AGM. Warren Buffett mentions that he wouldn't buy all the Bitcoins in the world, even for $25. The current market cap of Bitcoin is more than $1 trillion. And Charlie Munger, partner of Warren Buffett, mentioned that I avoid things that are evil, stupid, and make me look bad. And Bitcoin has all the three. Clearly, the Oracle of Omaha and poor Charlie are not in favor of crypto assets. How volatile new age assets could be? Well, one tweet NFT was expected to sell for $48 million. And the bid for that was just $280. This NFT was traded at 2.9 million last year. So instead of going from 2.9 million to 48 million as expected, it has actually fallen below $280. That will be 99.99% correction. Coming to the fixed income market, as I mentioned earlier, inflation continues to hound economies all over the world. In India, for last 3 months, inflation has remained above RBI's target level after a period of time. The number of rate hikes globally is more than 263, whereas there is only one rate cut. This was completely different picture from 2020, where rate cuts were 195 and rate hikes were just 5. If you look at the yield curve across US, UK, Japan, China, by and large, rates have started inching up. China obviously is an exception, as they have constantly lowered interest rates to support their economy. As I mentioned earlier, RBI surprised the market by raising repo rate by 40 basis points, and that also in between credit policy meetings. While compared to other parts of the world, India is better placed as its interest rates are high and inflation is under control. If you look at chart of spread between Indian real rates versus US real interest rates, we are in a far more positive territory compared to 2013. RBI has been masterly managing liquidity. They have brought down liquidity from about 10 lakh odd crore to just about 6,21,000 crore, partly aided by FX outflows. But within that, liquidity has been absorbed through CRR hike, through variable reverse rate repo options, and from overnight movement here and there. If you look at the current yield curve, it is very steep between 3 months to roughly about 3 years, where it suddenly moves up by 270 basis points from 4% to 6.7%. Thereafter, yield curve starts becoming flat, and a 10, 11-year security and a 40-year security are yielding almost similar returns. If we look at OIS curve, again compared to 1st June 2019, where it was a flat line, today it is fairly steep line, and we believe while the shorter end of the curve will go up, longer end of the curve should come down like it was in June 2019. The markets have discounted a lot of RBI action. The 10-year gilt minus overnight rate spread is roughly about 163 basis points since 2004. Currently, we are trading at 362 basis points. 362 minus 163, market is pricing in almost 2% repo rate hike. that is 4.4% plus 2%, 6.4% kind of repo, where few months back 10-year yield was trading. If I compare vis-a-vis US, my 10-year treasury yield and 30-year treasury yield is trading just little above historical spread between India and US. The spreads of lower rated paper have started expanding as investors aggressively move towards safety. Today, if we look at spread of triple B over triple A or A over triple A or double A over triple A, clearly they have expanded as weaker credits have been priced upwards. If we have to give a view on debt side, a lot will depend upon central bank, but also the movement of debt market will get influenced by what happens with oil, how does it impact Indian inflation, and more importantly, it carries out borrowing program so that yields continue to remain supported. Within fixed income, we will recommend investment to floating rate bond fund. These funds carry substantial exposure to floating rate instruments, and in a rising interest rate environment, floating rate instruments where coupons will get reset will be a far better bet. Across short, medium, and long term, we have variety of funds which will give a lot of options to investors to invest. The dynamic bond fund continues to outperform its benchmark index amid this volatile market. People, especially retirees, are today troubled at lower interest rates. They will be looking forward to invest in higher yielding assets. In our opinion, hybrid funds will be appropriate for investors, especially those seeking regular income. Our hybrid funds have done well over the years and delivered positive alpha across various time periods. One fund which has done extremely well is multi-asset allocation fund. On the way up, it gives about 64% participation. On the way down, it gives about 27% participation. Again, the upside to downside ratio in multi-asset allocation fund is roughly 2.37%. On the way up, you get double the return. On the way down, you have to participate for single the risk. Our current equity allocation in multi-asset allocation fund is about 56%.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.